Okay, welcome everyone to the Navigating the Financial Reset. If you're here for the first time, I'll give you a brief introduction about the program and what we do here. And tonight we have a very special session looking at precious metals, looking at gold, silver, and crypto with Josh Saul, who's the CEO of the Pure Gold Company. I'll introduce Josh in a moment, but it's his returning session with us. He was with us around about a year ago, actually. And what was really fascinating at that point, Josh was very clear that the market was seeing an influx of institutional money, central banks, hedge funds, and lo and behold, just last month, gold hit an all-time high. So it's fascinating to see how the market has evolved since our initial conversation. And a lot of our members and our audience have been very interested to learn more about this asset class, particularly given the economic uncertainty that we're still facing. Even though we're seeing, stock markets and crypto on the move, gold and silver in these times of uncertainty are often, a clear hedge. So we'll be asking questions about that tonight. Josh has put together some really interesting guiding points, which will be the fundamental basis of our conversation. And we're going to have a guided conversation tonight and give you plenty of opportunity to ask your questions. So I said I'd introduce this session as well. So the Navigating the Financial Reset program, we launched this last year, really to help people make sense of the changing economic picture and how the wider economic situation was changing in a post-COVID world where we saw this frantic money printing and manner of different calls for imminent recession and talks of soft landing, changes in the macro environment, the introduction of things like central bank digital currency. So we wanted to create a space where we could have open, holistic financial conversations about not only the big picture, but also specifically to look at the asset class of crypto, the emerging asset class of crypto, which of course is in the news cycle at the moment, in its approaching the growth phase of the bull run. We wanted to be able to have a really focused conversation, not only on the big picture and our role in that as an investor, learning techniques that can improve our financial well-being and financial independence, but really focusing down on the emerging asset class of crypto to help you navigate this complex and rapidly evolving space, so that you don't get caught up in scams and rug pulls and all kinds of things that can catch you out. So we meet twice a month. We have workshops just like this, one focused on the broader macro picture and one focused on crypto. We've now got a vault of over 40 different workshops packed full of insights to help you on your journey. So if here for the first time, we'll show you inside the program later on, so you can see what you can access if you decide to join us as a member. So as I mentioned, tonight is all about Pure Gold, but I will give I'll give our disclaimer as always. Nothing we talk about tonight is financial advice. It's a discussion amongst adults about adult matters when it comes to finance and any investment class, whether it's gold, silver, crypto, property, or others. Can go up and down and, of course, come with risks. So none of this material is intended to be direct instructional advice, but it is here to help you become educated and empowered on your financial journey. So what will we cover tonight? I asked Josh, given that if you haven't seen his prior presentation with us, he was with us, as I said, a year ago and gave a really deep presentation into the history of gold and the market and where it currently stands. And as I alluded to, made some... he was very, very professionally and cautiously gave some indications about where the market may go, and was right in his predictions. And we had that all-time high last month. So Josh sent us 5 different discussion points. We've seen the all-time high, but over the last 5 years, it's up 88%. So the big question is, once the market hits that kind of high point, where could it head next? Josh is going to touch on the hidden advantages of combining gold and crypto within your portfolio. This is a great, obviously, piece for those of you who are with us because of that connection to crypto. How to safeguard your assets against taxes and regulations. And there's been some questions around that, particularly around things like silver coming in. Why silver could be the most undervalued opportunity of the decade. I'm excited to talk about that because when Josh sent me that point, it really sent me on a rabbit hole of research, which I was quite excited by. So thank you for stimulating that. And some discussion around why and how gold was resilient against the latest UK budget announcements, which of course has caused quite a bit of frenzy in the UK. So it's not a presentation tonight. We're going to have an open discussion, but we'll use these 5 points as a guiding set of discussion points. And I will now do Josh the honor of introducing him properly. So Josh is the CEO of the Pure Gold Company, and you can see that the logo's there. Josh is back with us now for the first time. We partnered with Josh on the back of our initial podcast. So open, transparently, we work closely with the Pure Gold Company as a trusted provider. Based in London, a precious metals investment firm, established the company in 2014, leveraging his background in finance and commodities trading. Well over 15 years experience in the financial services industry, specializing in physical gold and silver investments, worked with a diverse range of clients from high net worth individuals and institutions. And under Josh's leadership, the Pure Gold Company has become known for its personalized and educational approach to precious metals investment. Regularly quoted in the media, financial media outlets offering insights on the gold markets and the wider economic picture, including Forbes, Reuters, Telegraph, and more. And under Josh's guidance, the Pure Gold continues to educate and empower investors through transparent discussions around gold, which is why we're delighted to have Josh with us tonight. And again, in terms of full transparency, our members of this program and our subscribers have collectively invested over £1 million with the Pure Gold Company now. So we're proud to work alongside Josh and his team to help you understand this market. So the big question is, are you ready to future-proof your wealth? Let's get ready to start the discussion. Josh, welcome back to the Navigating the Financial Reset. Interestingly, last month's workshop was how to use AI tools to help you research the crypto markets. So again, could be a highly controversial topic around accuracies and whatnot. So I thought I'd put it to the test tonight, and I got it to write your introduction. So if there was any inaccuracies, we can we can put that down to Perplexity, which is one of the tools we looked at last week. So welcome back.
Thank you very much. I think it's probably the immaculate example of plausible deniability. We can blame it all on the robots.
Yes.
Yes, by and large, I think it was probably correct. Thanks for having me on the show. It's been a while since we've done one of these, and I remember, I think it was about a year and a half ago, where you had me on the show and I gave a presentation. It probably more factual over the process and guidance and how it all works. And I remember you tried to help hold me to predictions for gold and silver, which I was reluctant to do at the time, just because no one has a crystal ball. But I think suffice to say, I think I was probably a bit conservative in terms of what's happened to the gold and the silver price since.
Yes, well, yeah, and I appreciate, I did say, professionally bound not to be giving advice or indicators. So you did a good job of keeping that. But we tried our best to pray out a prediction of you and from you, and you're absolutely right. And actually, that's, I'm sure Sam will agree, is actually what we value in terms of our connection here, is because we want holistic and open conversations. Within the parameters of these conversations, we look at, we don't stay in binaries. We go outside of those. We look at, all case scenarios in terms of best case, worst case, and everything in between, so that we can actually assess and become empowered to make sense of where we are, Sam.
Yeah, and I think, as we've often said, as Josh said, that no one has a crystal ball, but what you can see very clearly are trends and playing the longer term trends, and there are obviously trends at a shorter, longer time frames, but when you start to understand more, and the people who've been on lots of our calls, you're starting to get a picture much more of where you are with certain assets and why they're positioned. And just leading in, Josh, in our own group there, what with Bitcoin rising, I posted a chart even a few weeks ago that showed that essentially what we had was the same long-term cup and handle formation on gold that we saw break out. Then we saw silver follow, and that's why positively you'll watch Bitcoin go next, because a lot of these trends are about liquidity moving through assets from the larger to the smaller. So although exactly we don't have those crystal balls, you start to get a picture that actually we can see clear trends and start to understand why the market's moving, that it's not random, and that gives you such an edge over somebody who's just coming fresh with no awareness of where it's been or where it's headed and why things are moving. As we've always said, understanding, particularly when we look at both gold, silver, and things like Bitcoin, we are understanding about the money printing, liquidity cycles, how that is affecting asset prices, and how rather than just looking at an asset in isolation, you're comparing it to having your position somewhere else. And that's really what helps to make you a good decision, because you're moving because it's a good asset, but also you're moving out of something else because perhaps it's not a good time to be positioned there. And obviously I talk a lot about the money printing, devaluing, and that's something that's so stark, particularly with gold, and is always the great example of seeing what's happened, to the pound or the dollar, since 1971 to today, when you compare it with gold, it's one of the most powerful charts I ever showed people. So I'm sure you'll agree, Josh, it's a real wake-up call to many people.
Absolutely, and I think I think this presentation, this conversation has come at a great time because prior to coming on here, we did some research internally. As Dan, as you explained, we provide a very consultative, personal approach within the market in which we operate, which means that we get to really glean and understand people's underlying motivations for, purchasing gold. And that might mean that they're selling property to buy gold, or it might mean they're diversifying their portfolio with gold and silver and equities and other asset classes. And so we have a clear picture in terms of, first of all, who's buying gold at the moment and why they're doing it. And I think, it's a good place to start. And I think the relevance, the relevance of that question in relation to the conversation we're having right now lies in the fact that we've noticed that over the last 6 months, we've seen a 400% increase in clients that hold crypto that have wanted to start purchasing physical gold for the first time, right? And we found that trend really, really interesting. For us, when clients say to us they wish to purchase gold or they wish to purchase silver, broadly speaking, a lot of these motivations end up sitting in, 2 or 3 buckets. Clients want safety, security. They'll want, diversification. They'll want something private, something physical, something that sits outside the banking system. But then within those 3 buckets, you can branch off into other motivations in terms of, well, if I'm going to put my money into an area of crypto that might well have a volatility, let's say 5 times higher than that of gold, then it makes sense to add in some physical gold to increase risk-adjusted returns, which is what people do when investing in the equity market. What I wanted to kind of start off with is, a lot of investors are buying gold at the moment. We've seen global gold demand set a third quarter record at around 1,313 tons. Now, what I want to do is I want to address who first and then why second. We think of ourselves as investors, but before we think of ourselves as investors, we've got central banks, right? And over the last 3 years, we've seen global central bank demand set an all-time historic record. First of all, in 2022, that was nearly matched in 2023. And so far this year, we're on track to match last year's second highest ever demand. So overall, central banks they're already owning between 17 to 21% of all gold ever mined. And they're still adding to their stockpiles. Now, there are reasons as to why they're doing it, and there are reasons as to why they've done it more this year than they have over, the last 20 years, and I'll come on to that. We've then got hedge funds. Hedge funds, in their very nature, are designed to balance out risk with reward. If they were to put all their eggs into one basket, they're not doing anything short of gambling. They've stepped up their gold investments recently for the first time since 2022. We've got private investors. They've continued strong gold buying. And although the series of price records that are set throughout the year, what we've really now started to see is a shift in demand for smaller denomination and fractional weights. The Royal Mint, who we are an authorized distributor of, have said that 75% of their gold sales have now started to fall into the fractional coins and bars, for instance. And the reason for this is that as the gold price has now started to increase, and I think since the last time we spoke, it's increased by 40%, people have decided to purchase gold coins or gold bars that are less expensive, that are more affordable. And they're doing that because as the gold price increases, essentially what you're doing is you're future-proofing your investment. You don't want to have something that is starting to appeal to a smaller and smaller audience purely because the gold price is going up and less people can afford to purchase what you're selling. So that's that for us, that's been a really, really interesting trend. Then, of course, we've got the crypto holders that have purchased an increase of 400% over the last 6 months or so. And so, although it sounds glib, when you ask who's buying gold at the moment, the answer might as well be everyone. And so, when we start to look at why, it may or may not be a surprise to you that central banks buy gold for the same reasons. Private investors, purchase for the same reasons as central banks, for the same reasons as hedge funds. Last year, the World Gold Council polled central bankers about their top reasons for adding to gold reserves. And actually, they're very, very similar to the surveys that we do with our individual clients. So their top reasons are portfolio diversification. 10% in gold goes a long way if, let's say, the equity markets start to tank. All right. There's an old saying on Wall Street, put 10% of your portfolio into gold and hope that it doesn't increase. The implication being is that when gold increases, it's normally an indication that equities are suffering. And so ideally, like all insurance policies, you want to put your money into an insurance policy and not have to use it. But if you do have to use it, that small minority that you put into gold goes a long way. As I said before, risk reduction. There's lots of research out there. If you look at, the BlackRock funds, Vanguard funds, there's research that supports the notion that up to 10 or 11% of your portfolio in physical gold increases risk-adjusted returns by up to 3 or 4%. And essentially what that means is it's more return with less risk. You then got, privacy. A lot of our clients enjoy the fact that physical gold is one of the last forms of private investment left today. Unlike purchasing or investing in the equity market or buying a house or buying a car, where you're having to register ownership on a central database. Purchasing physical gold sits outside of the banking system. And that's particularly relevant when we start to talk about regulation, taxes, transparency. We'll come on to that a little bit later. Another factor as well is, of course, the devaluation of currency. Whenever we start to see uncertainty within countries, host currencies tend to fall in value. And that means it takes more of that currency to buy the same amount of gold, thereby giving the impression that gold has become more valuable, right? And so what you've got two things. First of all, what affects the gold price is the devaluation of currency, which gives the appearance or the illusion that gold is becoming more expensive, but actually in reality, what it really is that it's taking more currency to buy that same ounce of gold. Then the other metric is demand, right? And they're two separate metrics. What we've seen over the last, I'd say the last year, but over the last 5 years, as the gold price has increased by over 88%, we've seen not only a huge increase in central bank, hedge fund, and private investor demand, but we've also seen a considerable devaluation of currency globally, not just sterling, but also US dollar. There's also, another source of gold demand that might interest you. Gold is also used in technology, which grew by about 7% year over year. And so in addition to it being a financial asset, it's an excellent conductor of electricity that never tarnishes, right? It's a minority. When you're looking at, let's say, silver, you've got kind of half of half demand comes from industry, the other half comes from investment. And so that makes it a little bit more volatile, but we'll come on to that in a minute. I think, if I were the audience listening to this, I think one of the biggest questions that I would want answered is, why this sudden increase in crypto holders wanting to purchase physical gold, and why, when we speak to our customers and we ask them, why are you doing this and why are you doing this at the moment? Um, we make note of a lot of those responses. And I think, broadly speaking, and historically speaking, cryptocurrencies have an astonishingly high volatility. Bitcoin's 3-month volatility is, I would say, around 4 to 5 times greater than gold, as I was saying before. Now, that's high volatility. That high volatility is, I guess, another way of saying big gains, but also possibly big losses, depending on where you are within the market. And Sam and Dan, this is what we were talking about before, for people that are just trying to get into crypto, not knowing where in the market you are almost takes away the perspective as to, what's come before you and where you're going moving forward. And I would say, owning a high volatility asset and a low volatility asset combined with regular balancing lowers overall volatility and increases returns. It goes back to what I was saying before about increasing risk adjusted returns by 3%. So ideally, you want those assets to be uncorrelated as well. It's difficult to nail down Bitcoin's exact correlation, but it's most consistently correlated with risk assets, the NASDAQ. And since gold is a safe haven asset, it's safe to expect gold to hold up during risk off periods, just as you'd expect Bitcoin to soar during risk on climates as well. Would you say that's fair enough?
Absolutely, I'd agree, Josh. And I think there's another factor there that I think when you're looking at a crypto audience who are often looking at crypto because they're looking, to exit the banking system to a certain level, have assets in self-custody, but outside the legacy banking system, you've also got, I think, got an uptick in they're looking for the same reasons, i.e., more sovereignty within gold, also out being outside the banking system. Looking at the moment, but also I think a lot of people preparing because those who understand that there is money to be made in the current crypto bull market are thinking, well, where do I move to afterwards? If I am making profits in high volatile asset classes, and they are perhaps concerned with very bad reason about going back to the banks afterwards, where would they store their profits in a kind of stabler asset that is still escaping the centralized banking system, still escaping being sat in fear and worrying about devaluation. So I think that's also why you're seeing, people obviously getting involved now to rebalance, Josh, but also preparing to, dip into this market as well, understand it and get prepared and maybe have exposure now because they actually want to have a lot more exposure maybe 6 to 9, 12 months down the road. So I think that's also playing a role.
Yeah, I would agree with that, Sam. I think what we're seeing now at this stage of the crypto market in its ascendancy is you will see sophisticated, smart investors. They will take profits along the ride to the top. So they'll hedge their kind of thesis of the value increase in the next 3, 6, 9 months by taking some profits along the way. And absolutely, as you said, taking profits means where do we transfer that? They may take it into a stable coin to invest in further assets if there is a market drop, but they would probably want to put them into a safe holding, which is also offers some form of growth potential, but in a much more stable fashion. So I think it'd be very interesting, Josh, if we do this in 12 months' time, because we are anticipating some significant moves in the crypto space. And of course, everyone will have their own exit points along that journey. And I think actually at this point, from understanding where those exit points are, I think precious metals are a key. We had a really interesting discussion around property about a month ago. It'd be interesting to hear if you're hearing any outflows from property into gold later on. But I think this is another pulling driver. And I think the other variable is actually the people who start to invest in crypto. You of course have the speculative investors who are just kind of jumping on the trend, and we'll see more of that now because of the hype in the market. But I think those who are more sophisticated in their approach are actually, it's an entry point into learning about other asset classes. And we've seen that here with this program, is that when people start talking about crypto, they start learning about actually financial, they develop their financial acumen, and therefore they're looking across asset classes. So I think as a growth segment for gold and other asset classes like that, stable asset classes, I think it's really fascinating, because I think there's a push and a pull factor.
And of course, there's the underlying that people are, which has been the fundamental thing about my talks, since I began them 3, 4 years ago, which was really the first step is understanding the issues with the fiat currency system. That is one's real gateway to saying, rather than just going, I'm fine and I'm looking at these new things, these new avenues, it's actually the realization of the problems of where most people are sat without realizing it. And that is the gateway into looking at alternatives. And they're all linked. And like we said, they all have their different qualities and different ways they can help you. And that's why it's really helpful to always have a holistic view of it rather than have purists. I always find it kind of annoying. You see the sort of gold bugs debating the Bitcoiners and what. Whereas really, as we all know, they have different qualities, different use cases, and and fitting those to your personal situations. You said earlier, Josh, everyone's in a unique position. Whenever somebody asks me a question about, what's good to do, it's all about good education and fitting how that tailors into your level of your risk aversion, your situation where you are in life, also how technically comfortable you are to store your own crypto if you go that route. So all these factors are what is so key to educate about, so that then you can see the options very clearly and see how they fit with you. And that's critical.
Yeah, I think that's key as well. You mentioned something before about, looking at your alternatives, and I think it has to start and end with, what else is out there, because you can't, I think it's difficult to look at asset classes in isolation in a vacuum. Everything's relative to one another. And, a lot of our clients tend to be investment bankers, accountants, lawyers, but also we get lots of clients that don't necessarily have, financial training. They're particularly skilled in what they do, doctors or nurses or engineers, but they haven't necessarily dedicated their time or their life or their energy to kind of learning about, financial investments. But suffice to say, the journey that a lot of our clients start on is kind of looking to see what's out there. I think the first option, has to be kind of assessed. One can do nothing, right? They can keep their money in the bank and they can kind of wait. We've got a lot of people out there that wait, right? They're waiting either for the market to go up or they're waiting for the market to go down. But waiting is sometimes it's not always the luxury we have. I think the opposite of that is chasing opportunities that ends up with a lot more wealth destruction than anything else. And so I think it's important to kind of be balanced in relation to kind of impulsively jumping into something, but also waiting too long. I think, the alternative to investing is leaving your money in the bank. And we've got a growing cohort of clients that come from the investment banking sector that are particularly concerned about the breach in capital adequacy ratios of our UK banks, which essentially means them not having enough capital on their balance sheet to satisfy the growing amount of people that want to take their money out of the banks, right? And this is what resulted in the 2008 crash for Northern Rock and Lehman Brothers. Once the market starts to realize that everyone wants the same thing, everyone's trying to take money out of the banks, well, that's the point in which banks start to become pretty unstable, right? We hear it all the time. We hear them talking about stress testing. And then what they do is they refine the test at which they stress the banks, right? They try to see under what circumstances would a bank fail. Conveniently, what tends to get pushed off the table is the conversation about the deposit compensation insurance, which I would say is largely academic and untested, because we've only really seen it happen with one or two banks collapsing. That's Northern Rock and Lehman Brothers. And whilst they say that anything under a certain amount is covered, What they don't specify is how long it'll take for you to be made whole, right? And that's a big difference because, people have responsibilities. People have bills to pay. They've got mortgages to pay. They've got energy and outgoings to pay for. And so, if it's going to take, a government or a bank at best case, a year or 6 months to pay you what was in your account, then, you might get to a point where you've basically defaulted on every bit of credit that you've taken out, right? And most people have mortgages these days. And so, when we start with the banking industry, your worst case scenario is that, not being able to access it when you want it. That might be temporary, that might be permanent, who knows? Hopefully we're all wrong about that. And it would be a temporary kind of obstacle in terms of accessing it. But I think more common on day to day is that whilst we're led to believe that inflation has really dipped, we all feel it. I don't know about you guys, but when I go into a restaurant or a shop, I feel that things are a lot more expensive, right? It's either that they're making things smaller and charging a little bit more, or that, you're getting less value for the things that you're purchasing. But, if we're using the real metric for inflation, I think that we're going to see that inflation is still sitting in around the 7 or 8%, which means that best case scenario, banks don't go under, banks are absolutely fine, but you've got a guaranteed loss to purchasing power because banks are only going to give you around 3%, right? So it's a slow erosion of wealth that kind of compounds over time. And I think the other thing worth saying is that one of the biggest misconceptions is that when the government says to us, well, inflation is only at 3%. Well, let's just accept that it is at 3%. That's 3% per year, right? So every year things are becoming 3% more expensive, but that's 3% on 3% on 3%. So that's compounded. That's compounded inflation, which means that if we take the government's word for it, things are still becoming a lot more expensive than they were, let's say, 5 years ago. And so, we then have clients looking at, the equity market. We've had a lot of people holding on the words of Michael Berry, who predicted the 2008 subprime crash, whilst everyone believed that the market was going straight to the stratosphere and beyond. Michael Berry, who was featured in that film, The Big Short, was a small minority of people that basically bet the other way, right? And he believed that there was going to be a market crash based on the fact that more people were taking out mortgages they just couldn't afford to pay back. He couldn't believe that no one else could see this. And because of it, he was able to buy these CFDs, these insurance swaps, for literally nothing because people just thought they were just taking money off them. And lo and behold, we saw it. If any of you haven't seen The Big Short, it's one of my favorite. It's one of my favorite films because I think it dissects and it simplifies exactly what happened then. And the reason I'm mentioning it is because he's making the same predictions at the moment. He's actually he's bet 1.23 trillion that the markets are going to go in the same direction. So he's not, there are lots of people out there that have opinions and thoughts and, analysis and 1 week they'll say this and the next week they'll say that. But, he's one of the very few people that actually stake his financial reputation on the line. And so, when we're looking at the Smart Money Flow Index, which shows us kind of the institutional flow of money in and out of the market, we're not talking about private investors or even ultra high net worth individuals. We're talking about institutions, BlackRock level of money. We can see that money is exiting from the equity market. That's not to say that it might not continue to go up, but I think the institutions, they're not just looking at how high can equities go. I think what they're looking at is they're looking at fundamentals on a relative basis. They're looking at, well, it's increased by X amount. how can I profit take and bank some of that profit in order to leverage another asset class that might well be at the beginning of its cycle, right? And that's why we're now starting to see a lot of these institutions starting to look at the likes of crypto. We've seen a lot of these institutions, they've been in gold for many, many years for the same reasons that we've discussed, diversification, wealth protection. But I think it's interesting now they're starting to look at cryptocurrency as well. And I think, you mentioned something before about, sitting outside of the banking system, because I think, 10 years ago, people that talked about privacy and wanting to ensure that they can kind of have their wealth out of the banking system and away from the nanny state would be regarded as a conspiracy theorist. And I think nowadays, it's a commonly adopted view that, whatever sits within the throes of the banking system almost gives impetus to the government to decide to either regulate or tax, right? And we know that, regardless of anyone's political affiliation, we're now sitting within a government who want to tax more in order to pay for things that they believe need to be paid for. The money has to come from somewhere, right? They're also, crypto adoption has been outpacing regulatory clarity for a while now. And some would say all the industry really needs is clear regulation, because, the last few years have been a mess. You've seen lots of scams. Sam, you were mentioning it before. If you don't know what you're doing, you can walk straight into a Ponzi scheme or a scam, or, sometimes these things look completely untowards on the surface. And so, there've been kind of countless victims that have moved into the cryptocurrency space and have lost everything, not because they've made, a bad investment, but because they've literally had money taken away from them. This is why I think, what you guys do, Dan and Sam, in terms of educating people is absolutely crucial, if you're going to start investing in these sorts of markets. Regulation, I think, is a good and a bad thing in a way, because I think, let's face it, capital hates uncertainty. It always has. And so I would say the positive, and maybe I'm looking at this a little bit too optimistically, but I believe that regulating crypto exactly the same way as any other asset class, with clear rules, investor safeguards, appropriate oversight, is all that's standing between crypto and major institutional investors. And I believe that not only is the regulatory landscape going to get clearer, but that clarity will, I believe, unlock a massive amount of funds, not from just venture capital, but BlackRock level money.
Yeah, I'm going to jump in there, Josh. I think you're absolutely right. It's regulation will undoubtedly bring the next wave of institutional funds and big money, and it's already coming in. And it's interesting. It's interesting. So, for what you were saying about the people who are dismissing others as conspiracy theorists for wanting privacy 10 years ago, it's interesting. If you actually look at their behavior, they're the ones looking to offshore their money and open bank accounts in different places and names. That they're actually living it in a different way. And similarly, we've seen it with crypto. We've seen major institutions deploring crypto, just giving all kinds of disparaging terms. And then you look at their balance sheet and say, oh, interesting. You were just on television saying you reject crypto, and oh, look how much Bitcoin you've now bought. Oh, and you're now launching an ETF fund. Oh, right. Okay. So you're really against crypto. You just like to keep the price low for when you enter the market.
Exactly.
That's my skeptical side. And the other piece around regulation, there's I don't know if you've heard this before in other contexts, but there's a term, and it is a skeptical term, but it says regulation is legalized corruption. Because what it does, it enables things to happen at the higher echelons of the financial markets in a way that will grease the wheels for wealth to continue to flow upwards, and often that regulation, which is why we're balanced on it, because we can see how it will further unlock the market and lead to mainstream adoption, but it will also create barriers as well. But it has been, we have had the Wild West, and as a result, freedom in itself does come with responsibility, and as a result, there is greater responsibilities in managing crypto. It's not the easiest asset to move into and to keep secure and keep private. There's extra steps, and you have to learn how to do that. It's not as simple as I'm just going to open a bank account and type in my password, and if I forget my password, I'm going to call internet banking and they're going to sort it all out for me. We don't have that. So privacy, security comes with responsibility in the crypto space, but absolutely the changing regulation game will, and knowing that that's likely is again a validation point for the market as a whole, as is the mass adoption in the mass. I mean, last year's bull run as a result of the institutional inflows was a key point. I have a thesis and a speculation that yesterday's smart money may become today's dumb money, on the basis that we've got the same human psychology that you see in other markets does apply here in crypto. But I'm curious to see how institutions respond to high volatility, because whilst they expose themselves to other markets and other asset classes, I'm not convinced they know how to handle at the institutional level. If you think about it, if you're a major corporation and you're holding a sizable chunk of a volatile asset on your balance sheet, and that takes a nosedive, there's a very significant risk that could put you seriously under financial pressure as a business. As an individual, it can, of course, but as a business with all those extra obligations. So again, from a point of understanding the emerging relationship between crypto and gold, it wouldn't surprise me to see some institutions get burnt in the next phase of the cycle when the greed really ramps up. Whereas in other markets, they may actually know how to navigate that. I'm very curious. It's only a thesis. I'm looking to see how the bigger accounts fare in the bull markets. But again, I think what it will lead to is outflows into other asset classes. And Sam recently spoke. Maybe you'll just touch on this very briefly, Sam. The 18.6-year property market cycle. Yeah, the 18.6-year property cycle, which is indicative that we could be entering into. And it's interesting to hear what you say about Michael Burry, because that was again grounded in property. And obviously, I haven't. So I'm hearing this for the first time, what you've shared, but I'd be very interested in what his thesis is based on. If he's also witnessing patterns in the property market, because increasingly, that's why I said earlier on, I'm curious to see if you're seeing inflows into gold from property, because that for me would be an early warning sign that those potential risks of a property market collapse could be showing in ways that you might not predict, such as moving money out of property into gold, which could be a really interesting indicator. Sam, I'll let you touch on that.
Yeah, just to touch on the regulation first. Yeah, I mean, I think again, it's absolute Wild West, and that's why it is so important to learn and get the skills. But there is obviously, it goes to this idea of it's all about the intention behind it. So it's like when I talk about blockchain, the future financial blockchain system, which is coming in, and CBDCs. If there was no agenda behind it and the intentions were good, it could be a very similar financial system in a more efficient technological way, better settlement times, fairer system. So it's not the problem. It is the intention behind it is the problem. And that's the same with regulation. So the double-edged sword is there are areas of this crypto market that is so Wild West that it does require some regulation. The issue that I think most people on this call have, myself included, is that we feel that a lot of that regulation will be curbing some of our freedoms to make the choices we'd like to as sovereign beings who take our own responsibility, and will much come down in a way of safeguarding the big players and perhaps in using the guise of protecting the smaller player, but actually often that is locking the smaller player out of the market, or saying it's not safe for you. You're not big enough player to play this game. We're going to keep you safe. We're going to keep you safe in the system we want you in. And you alluded, Dan, the perfect example being the one I always give, because I pulled up the articles where Santander are blocking people, buying more than £3,000 a month worth of Bitcoin, whilst they're actively helping their private clients in Switzerland buy as much as they want, and they're buying it themselves. So it's this do as we say, not as we do. Yeah. And the real issue is that regulations, the likelihood they will, look to maybe impinge our ability to perhaps buy a lot of the assets that they are, stockpiling themselves. But on a pure investment side, and that is where there are all these different angles to it, Josh, and I totally agree with you, where the other side of it is that there is this huge, vast amounts of liquidity that wants to come to this future tech market, because that's essentially what the crypto market is. They understand it's the baseline tech of the future. but they can't come in till it's fully regulated and there's full clarity for, compliance reasons. And that is a huge wave of money. And essentially, in terms of looking at this from a pure investment point of view, investing and having an exposure to the blockchain, as a whole, that investment class, you are interested in a unique time in history where you're front running that money. Now that's quite a unique thing in history. That's why it's quite a pioneering move, and we can do that at the moment. So there is the two edges of that sword where there may be much more control, but equally that is also what's going to make the market go absolutely stratospheric over that next, 10, 15, 20-year period. And yeah, I was just wanted to allude to really interesting, talking about the Big Short and Michael Berry and going back to 07, 08, that for people who've watched that workshop, if you haven't, go back. We've got it in the vault. Did really interesting thesis about this land and property cycle, where when we look back through history in the last 200 years, all the big crashes were actually land and property value based. And that's what really pulled the markets down. That the other crashes we've had have been much more surface, either stock market crashes, but the real big ones have usually been in that sort of 18 to 19-year period of the land and property cycle, which a lot of people pioneered investigating. And we are, interestingly, due that around this window of 26, 27, 28. Okay, and that's really interesting. And again, I think what we're seeing, and I'd agree, there are big players who would have an awareness of that or going to be preparing for that. And that's also, also why they're moving. But I think I wanted to touch on something, because I often see very over dramatic posts like, Warren Buffett's taken his money out of Apple, the stock market's about to crash. I think they're really interesting indicators, but I think it's really important to understand, and I think Josh alluded to it, the scale of money these big players have is so great. They're making moves on a different time frame from the average retail investor. And so they don't need to necessarily ride the rest of the stock market up if there is another 6 to 9 months of froth where it could really be life changing for maybe a retail investor. But for the big players, they are working at a different time frame, at a whole different level, and a whole different what they need to do. So all I wanted to say is, not to get too attached to reacting directly just to those, because I see people react crazily to a tweet about it. And it's again this hyperbole of that means it's going to crash tomorrow, he knows. I think it's important to understand they are playing from a different perspective as well. But equally, they are perhaps prepared for that next drawdown, which is, I'd argue quite likely to happen over this next 3-4 period at some point. And that's equally where I think gold and silver is going to play a huge role, Josh, for many people who are clued up to it, is to understand that perhaps there is riding this bubble and people are exiting the bubble, hopefully before the top or near the top of the bubble, to then sidestep into these stable hedges like gold and silver and be able to protect their wealth, which gives them the ability to perhaps purchase things again when they're back undervalued, back in these crashes. Because again, what we're seeing is not the end of the world. We're seeing things being undervalued again, a lot of fear, but that is also a great opportunity, which is why we've always said it. The people who play those waves, exit, sidestep, and go back again are always getting richer. But unfortunately, financial education is a level where so many retail people buy the tops of bubbles and then are wrecked within the crash and unable to, buy the bottoms of those cycles. And that's the pattern we're trying to get out of just through education, holistic education.
Absolutely. And I think, the consensus amongst a lot of our clients when we ask about, where they believe, the regulation of the crypto market will end up. And I think there's a general consensus there that, yes, it will open the market up. It will kind of attract a lot more funds. And yes, it may well increase the value, the overall kind of market cap of, cryptocurrency in its entirety. But I think, the governments are then well poised to then start turning on the tax taps, right? And, we've already started to see it happen, right? People are now starting to think strategically about, well, where do I do this in the world? Where I can actually do this in the same way as I could have done it 10 years ago, right? We've got Labour now starting to talk about wealth taxes, right? And, I would have thought, one of the first places they're going to want to look is crypto, just because there's been, huge gains. You've got people, I was talking to someone the other day, that it was actually a wealth manager who said that he's had kind of a couple that he's been managing their portfolio about 25, 30 years. And they bought, back in the day, I think it was like 30 or 40 Bitcoin. right? And it was nothing, and they just left it, and they just, like everything else they bought, they just rode the market out. They didn't think too much about it. They didn't look into it, and they're sitting on a huge amount of money. And they're not typically wealthy individuals. They're comfortable, but I think cryptocurrency can take ordinary people, ordinary middle class people that have worked very hard throughout their life, and all of a sudden they're multimillionaires, right? And it's a known phenomenon from the governments that if they're looking for more tax, then it's probably a good place to find it. And so, the number one response we got to, well, why are you purchasing more gold now? And some of those answers were, well, we want an uncorrelated asset class that will go up when there's risk, and versus crypto where it might go, the other way. But at the same time, with physical gold, there's no tax. So it works in the same way as classic cars or watches, for example. Any gain that you make with physical gold is completely exempt from capital gains tax. And so ever since the release of the budget, whereby capital gains tax went up from 10 to 18% for basic rate pairs, from 20 to 24% for high rate pairs, which effectively, you're looking at an 80% increase in capital gains tax, we've seen a massive inflow of people looking to put money into physical gold purely because whatever they make, they keep 100% of it. And so, you've got the capital gains tax advantage, you've got the diversification edge, whereby, when other markets are falling, gold will increase. And if you don't want to see your gold increase, then you take comfort in the fact that the rest of your portfolio is doing okay. But at the same time, one of the biggest things that everyone's talking about right now is inheritance tax, right? They're making that a lot more restrictive. We pay tax on our income, we pay tax on the things that we buy, we pay tax on the money that we're left by our loved ones, and then when we want to spend that money, we're taxed again. And so, the way the gold comes into this in a way because it's physical and it's private, which means it sits outside the banking system, which means that it provides you with a degree of flexibility when it comes to bereavement or intestacy, in terms of being able to leave your wealth to your loved ones. I'm not saying don't pay tax or inheritance tax, but what I am saying is that it puts you in a position whereby, if God forbid someone passes away, the estate isn't locked up for 2 years whilst you're trying to kind of fight, tooth and nail, trying to kind of unlock it and extract value from it. At least for physical gold, at least you've got something that may well sit outside of an estate that can be instantly liquidated for cash in any currency, depending on where you are in the world, which you can actually then use to help you through probate, whether or not you decide to pay tax or not. And obviously, I'm not condoning that you shouldn't, but what I am saying is that it provides you with a degree of flexibility. People often see it as an alternative to leaving money in the bank, but in a way, what you're doing is you're having it sitting in something that's physical, something that's tangible, something that doesn't lose pace with inflation, like leaving your money in the bank. And at the same time, there's no counterparty. You're not having to worry about a third party's balance sheet. You're not having to worry about, is this bank secure enough? Is this fund secure enough? Is this institution, will they be there next month or next year? The only person that you really have to rely upon is yourself and your memory, in terms of knowing, where you've stored it and where you're keeping it.
I'd like to ask some questions on that, Josh. So I think there are some concerns about the change in government recently when it comes to tax. It seems to be very tax focused. And as a result, I think that is a concern, certainly in the crypto space, but I'd be curious about your views on gold. On the crypto side, we had Jamie Nuttall from Minor Accountants with us several months back, who already shared how the previous government and undoubtedly the current government are already going for past gains in crypto. So I think it's only a matter of time that becomes a real issue in that space. But are you seeing any indications of potential regulatory or tax changes in the space of precious metals in the face of the new government?
No, we're not. And I can't say, never, because, I think we have become increasingly surprised by the unsurprising over the last 5 years. The things that we least expected to happen have ended up happening, from certain people running the free market economy to, five prime ministers over the space of 4 years. It's been like a very bad episode of the West Wing. Um, However, there's a reason why physical gold is exempt from CGT, and that's because, and it's not for all gold, it's for UK legal tender gold and silver coins. And the reason, what makes it CGT exempt is the fact that legal tender coins have a face value. And the face value, in the same way as you pick up a £1 or a 50p, it'll have a face value on that coin, right? So, for example, a 1 ounce Britannia, right, that's worth over, £2,100 has a face value of £100. Now, if you were to walk into the Bank of England, they would have to exchange your 1 ounce gold Britannia for £100. Now, you're not going to want to do that because you'd be massively shortchanging yourself. But the principle I'm trying to indicate here is that legal tender UK gold coins are regarded as currency. And you're not allowed to tax the flow of currency. That's been a firmly entrenched principle of UK law for hundreds and hundreds of years. And so whilst I say never, one can never say never. If they were to try and untangle that, effectively what you've got is you've got foreign exchange, you've got currency. You can't tax the flow of currency, which includes foreign exchange, right? And so it would be a huge exercise for the governments to have to untangle and separate legal tender from foreign exchange. The reason why they don't tax the flow of currency is because it would make currency less desirable. And the objective of the government is for everyone to put their money into host currency, right? It gives the government a lot more control over, the balance, over balancing the books. And so I think two things. First of all, I think it would be uncommercial of them to do that, because effectively they would massively devalue the currency in which we're operating in, because people just wouldn't want to sell currency if, of course, they've made a gain. The second of which is, I said before, 17% of all gold in the world is owned by central banks, and they're adding to that every single year. And they're adding to that because they're looking to remove exposure to the dollar, and they want real wealth in something that is going to grow. But if, let's say, they decided to impose taxes on physical gold, then I think the natural order of things is that, demand for that safe haven asset would probably decrease. That's not to say there aren't lots of other benefits and reasons as to why you should be purchasing it, but for a lot of people, not having to pay the CGT, legitimately speaking, is a huge sweetener. And so if gold demand goes down because of that, then the value of it goes down, which means the value of the gold that the government is holding goes down. And so in a way, it's counterproductive. They're trying to collect more tax, but at the same time, the value of the country's gold that they're holding has probably fallen by more than the amount of tax they're trying to collect. And so I try and look at these things with a business brain, right? Commercially, it doesn't make sense to me. And so, governments don't always do things that make commercial sense. I get that. But, we'd like to think that, they're going to have advisors around them that say, well, actually, if you were to do this on the left hand, you're going to hurt yourself on the right hand. in exactly the same way as they were talking about possibly increasing capital gains tax to the same level as income tax. And actually, there are various studies that show that whilst on the face of it, in an ideal world, increasing capital gains tax to income tax should bring in more money, it's counterproductive, because it would just mean that less people will sell assets. And if less people are selling assets, then less people are paying capital gains tax altogether, which means they're collecting less tax despite the fact they put up the tax rate.
Yeah, very.
That is my very long-winded answer to that question. I apologize.
No, it's an important answer. Thank you for that. We'll come to some broader questions on taxation. There's been some in the comments as we've been going through. Just leveraging off the point on tax, it might be an interesting time to segue to looking at silver, because I'm curious to know the differences when it comes to investing in silver and gold when it comes to taxation. But I'd like to bridge that into a conversation around why silver could be a really interesting asset class in the next decade.
Yeah, well, I think, silver is, we sell both gold and silver. We're called the Pure Gold Company, and so it's by no means of a surprise that we sell more gold than we do silver, mainly because, gold tends to be, the staple diet of safety and security. Silver, on the other hand, is known as gold's volatile sister, right? And so what we tend to see is that when gold increases, silver increases, and it probably increases to a larger extent. But the converse is also true. When we start to see gold decrease, we see silver decrease to a larger extent. And so the volatility is a lot higher for silver than it is for gold. And that's what you tend to see with asset classes that are a lot cheaper, right? The higher the value, the more stability they have. But that being said, we know that the silver price tracks the gold price. And so, if you're looking at experts and analysts that are predicting that gold is going to increase to the same level as it did between 2012 and 2015, where we saw roughly, 300% increase, then by implication, we know that silver will somewhat track that. There's always been a ratio of silver to gold. And up until about 2004, 2005, the historical ratio between silver and gold was around 12-1. And so it would take 12 ounces of silver to buy that 1 ounce of gold. And then 2005, 2006, the gold price started to shoot up. 2007, it took off. 2015, it took off again. And so what's happened is that ratio has massively widened. That ratio between gold and silver now sits around 90-1. And so it takes 90 ounces of silver to buy 1 ounce of gold. And most analysts and experts would say that silver should be trading right now, adjusted for inflation, it should be trading at around $120 an ounce, right? And so not only is it massively, massively undervalued, but we're now starting to see, the smart money, the likes of JP Morgan and a lot of the other funds starting to, quietly but very quickly corner the silver market. The difference between the two metals is quite interesting, because the gold market is much larger, much simpler than the silver market. Only about 7% of gold demand comes from industrial and manufacturing applications. But silver, on the other hand, has nearly equal demand, right? 50%, 50% from industry and from investors. And because it's both a precious metal and an industrial necessity, silver's price is much harder to predict. The supply picture is much easier to understand. So silver mining fell behind demand back in 2019. And this year's deficit alone is projected to hit 265 million ounces, which is double last year's shortfall. Now, with gold, when there's a supply deficit, the mining sector responds, right? More exploration, more development driven by higher profits. But silver mining is different, because about 70% of mines that produce silver primarily extract base metals like lead zinc, or copper, and then silver's recovered as a byproduct, right? And what that means is silver supply is a lot less elastic than gold supply. It's less responsive to price than you might expect. But this is where I think the really interesting thing for silver comes into play. If we take into account that supply for silver is really difficult to predict, despite the fact that demand for it is increasing, there's no guarantee that we can increase supply to match demand, right? And once we start to get to those crossroads, once we start to get to the point in which demand is much, much higher than supply, well, that's when we start to see silver behaving like gold did back in the 1980s. And we know that it's increased by kind of close to 11,000% since then. Silver's crucial. Silver's a crucial input for a number of rapidly growing industries. We've got solar panels. Each one uses around 20 grams of silver. Demand for photovoltaics is seen growing 25% a year for the last decade. Electric vehicles, I would say probably in around 10 years, most cars are going to be electric. Every Tesla has around 25 to 50 grams of silver. And car manufacturers at the moment are using around 55 million ounces of silver per year. These are some of the fastest growing industries by far. And so overall, what we've got is, rapidly growing demand, a 5-year supply deficit, and an industry that simply can't respond effectively to rising prices. I personally believe silver has much greater growth prospect than gold over the next 5 years. And I think it's rare that you've got an asset class that can champion for uncertainty in the same way that gold can. Uncertainty and risk, gold goes up, silver follows it. But once we start to see green shoots to recovery and industrial growth increasing and GDP increasing, and all of the things we start to see on the news tend to be good as opposed to bad, pre-2008, then demand for cars will increase. Supply of cars will increase, which means that demand and reliance on silver will increase. And so what I'm trying to say is silver has a part to play in markets that are very risk adverse, but it's also got a part to play during, growth periods, economic booms.
Yeah, Josh. I mean, this part here is exactly what caught my attention with silver. I mean, in the notes that you sent me, as I said earlier on, it led me down this rabbit hole of understanding the different trajectories of various different markets. I mean, I'm someone who's fascinated by innovation, and with regards to what anyone might think about the politicization of the current energy sector with renewables, it's quite evident that there is trillions moving into the renewable energy markets, and it's still in its infancy. And with silver being a vital component within those markets, it's inevitable to grow. So and I liked your term, looking at things from a business point of view, if you've got a growing sector and you understand the raw materials required for that sector to grow are going to come under intense demand, then unless the supply of those ingredients can match the pace of its demand, then of course the value of the asset goes up. It's just a fundamental principle of the markets. Therefore, I think silver has become a very interesting use case for everything you've just said. And then on top of that, you've got gigantic emerging and developing markets like China, India, Japan, who are often seen as at the forefront of technology, and they are, but they are huge economies that are still really in the ascendancy. So, and that applies, I think, to not only the industrial use cases, but also the individual use cases as well. As developing countries become more wealthy, more economically sustainable, then the luxury goods therefore start to gain traction. So, what we take for granted in the developed world, you walk down the high street, jewelry stores, etc., those aren't a thing in certain parts of the developing world. So all of a sudden, not only do you have the industrial use cases, you also have the individual use case in jewelry, etc., in these massive economies. So to me, and I didn't realize that for what you said around the mining, basically a byproduct essentially. So it has that supply constraint. So I just go to market principles 101, and if that assertion around gold from where it went in the 80s is, as many others are saying as well, is accurate, then I think it's made its way onto one of my most wanted assets. So
the other thing is true as well, Dan. If we accept that if the components required for those assets are becoming more expensive, then the asset becomes more expensive. And if the asset becomes more expensive, then that contributes to higher inflation. And if higher inflation is starting to present itself, then that leads us back to physical gold, because you're going to want to hedge yourself against high levels of inflation. And essentially that's what physical gold and physical silver essentially do. The definition of a commodity, the definition of physical gold is the rise in, the definition of inflation is the rise in cost of services, in goods and services, and commodities. Sorry, I've really messed that one up, haven't I? The rising cost of services, goods and commodities, which by implication includes gold and silver.
Yes. So what's interesting, actually, when we put out a note recently to our subscribers, we were looking back at when we started this journey on with this group, and we looked at the very first date that we went live. If someone had taken £1,000 and put it into Bitcoin the day that we started in 2022, it would be worth over 4,500 today, which is a massive gain. If they put £1,000 into gold at the same day, it would be worth 1,700 today. So again, not quite as significant, but a stable growth. And again, the juxtaposition of stable growth versus high growth is important for all the reasons you've outlined around volatility and stability. Contrast that with, if you believe the government figures, an average of inflation rate over that period of 6.3%, then the real value of your £1,000 in cash, if you just kept it in the bank, would be worth £885 today. So, which of those asset classes do you think have the better opportunity for building financial stability and independence? Well, certainly everything other than cash in that instance. Now, again, it's not diminishing the value of cash for its role in the economy and for privacy. It's simply, as Sam always says, it's understanding the chart that you are in. And if you stay purely in the cash chart, then with these high inflationary periods, and there's no doubt that we have gone through it. I mean, you were talking about the shopping experience. I had a shock moment the other day. I bought a loaf of bread, and I got a little bit of change left from a fiver, and I thought, what? I'm not in London. I'm not even in Bournemouth. I'm in Boscombe, which is like a small area inside of Bournemouth. It's a nice loaf of bread, but £5. Yeah, so
I've got to London now. I've got to London.
It's probably cheaper to get a loaf of sourdough in London. It's cheaper for me to get on a train and get myself. Yeah. So you're feeling inflation is a real thing. And, however the government determines its quote unquote basket of goods and services to determine that rate of inflation it has changed over time. Yeah. And there are incentives that drive those changes. But frankly, there is a real tangible effect of inflation. And unfortunately, most people, if you look at your bank account, of course, the number doesn't change. It might even change favorably if you've got an interest, very marginally, in a minor case, if you've got a savings account that pays, 3% at best right now, you may see a very subtle increase in your value of cash, but that most people don't adjust that for inflation. They just simply don't. And when you do adjust your cash for inflation, that really paints a stark picture. So even on a very simple level, and I worked in financial services for 8 years prior to leaving that industry in 2012, and so many people it was shocking. I worked in personal banking for a period. The amount of money I would just see sat in bank accounts, just in current accounts, was shocking. just shocking, and for a number of reasons. One, firstly, if someone's going to steal your bank card, having all your money in your current account is the fastest way for it to disappear. If someone's going to, if someone's going to, attempt to steal your funds. But secondly, you're not even taking action to even put their money in a savings account, let alone consider other asset classes, which is why I think we've got a fundamental financial education problem across the board. Which is why I'm very excited about what we're doing here, is to help people understand the chart that they're in, as Sam would say, but also understand the different charts that are available in order to navigate the economic situation we're in, which is characterized by economic uncertainty, but also political uncertainty. And it's almost interesting to look at every political election now brings massive amounts of uncertainty. We live in a world now where social media drives polarization and tribalization. So it creates even more chaos. It's almost civil war breaks out online when there's an electoral cycle, if there's a controversial character. And that just contributes to people's overall uncertainty, but it also creates distraction. So, people aren't focused on their future trajectory when it comes to their own financial independence. So having access to conversations like this is paramount if you actually want to adjust the course of the chart that you are in, because there are people like yourself, so there's programs like this that can help people understand the mechanics of the different markets, and working with people who understand the mechanics gives you the not only the knowledge of what's possible, but you can then start to assess what's most important for you. And I think what's important for me from today's conversation, I hope others are taking this, is the paradox of high volatility versus stability. Because at this moment in time, and I think, Sam, you would probably agree, and I'll come to you to counter this, as we enter into the next possibly parabolic phase of crypto, the greed index, and there is an actual, for those of you who are new to crypto, there is an actual fear and greed index. You'll see it in many different markets. When that goes tilting off the edge on greed, it's when people flood into the marketplaces. And as Sam always says, most people who say they've got a story about losing money in crypto isn't because of a scam or a pyramid scheme or anything of that ilk. It's because they bought at the top and sold at the bottom. That is the same in any market, because what happens when you go over that edge of the cliff and it starts to plummet, people start to panic, and they don't think long term. They don't think between now and when the next wave is going to be, and that's where people create losses. So having understanding the market psychology is vital, but also understanding the different options that are available for you. But during this parabolic phase, that's where I think that risk is high again for people making mistakes. And you'll also see people saying, I'm going all in. It's like going to the casino and taking all your chips and saying, I'm going to put everything I own on that number over there on the blackjack, on the roulette, because it's on a roll. And I know people in my network who are doing that. And, it's a very high risk strategy to do that. And again, if you look at the principles of smart money, and I'll come to you on that, Josh, smart money diversifies. They have certainly not got all their money in cash, and they have certainly not got all their money in crypto, and they haven't got all their money in gold. It's diversified. And that for me is the most important principle. Sam, we'll come to you on the response to the market and what that could, the risks that come.
Yeah, and I think you're absolutely right, Dan. What you see is the new investor who gets more sort of led along by the hype and the narrative. They're aggressive at the wrong time, so they're aggressively buying near the tops of bubbles with a FOMO, rather than really be someone is aggressively accumulating things when they're undervalued, and then moving into a defensive mindset. I mean, still, I mean that in a still expansive mindset of taking profits, but in a defensive mode when that market gets in that scale. And something that Josh alluded to, just always important to reiterate, you have to write down this sort of question of it's so dangerous, so volatile. Part of the volatility is just because of the size of the asset class. So as Josh said there, when you look at gold and silver is much more volatile because it's a much smaller asset than gold. So it takes less money in and out to move it. And that's really all we see is crypto at the bottom of this pyramid of an even newer small asset class, Bitcoin being half the value of the whole crypto market, so being the large dominant asset. And as you go down into this vast world of altcoins, you're getting extra volatility, all tied to Bitcoin, as we always said, like Josh said there. Silver is actually following gold, but also the altcoin markets are all following Bitcoin. That's the limit liquidity, but they're going to have extra volatility both on the upside and the downside. You've always got both sides of the equation, the yin and yang. So That's really important to understand that it's not a problem with Bitcoin. It is a nature of it's a nature both of the size of an asset and of human emotion and market cycles, and that's what leads them to have these kind of parabolic phases and these big sell-offs. So when you understand that, you're going to have a much more balanced view on it.
Yeah, thanks for that. And then Josh, I'd be interested in your just points on diversification and the importance of gold and silver as a strategy for diversifying, because even if people aren't, we obviously we have an edge of crypto here, but actually we're also often talking to people who are simply entering into the financial ecosystem for the first time, and they may have got a financial advisor who of course would have taken commission for selecting a certain set of stocks or equities, but entering as an individual investor for the first time, discovering the principles of investing. How do you see gold as an important diversification asset?
Well, I think, if we look back over the last 5 years and we see that it's gone up 88%, one has to ask ourselves, well, what happened? Why such an increase? Why do people decide it was going to protect them? Did it protect them? There was a pandemic panic, right? A global economic shutdown and a rush to safe haven assets. And then there was a global response to that panic. And because of that, we saw unprecedented money printing, quantitative easing, as it's called, combined with near zero interest rates. And somehow the subsequent wave of inflation that swept across the world seemed to take central bankers by surprise. And that fueled demand for gold from private investors and hedge funds and central banks. But inflation degrades the value of the currency that they own at the same time. So throughout these periods, we saw global currency, become devalued. Now, there's a big part of the story, and there's a reason the IMF is concerned about global debt levels. The second thing that drove massive gold demand was the unprecedented weaponization of the US dollar against Russia in response to the invasion of Ukraine. President Biden didn't just freeze Russia's dollar reserves. He led the entire NATO organization to sanction Russia and banned Russian banks from the SWIFT network. So he basically blacklists not just an entire nation, but its currency too. Now, the US Treasury widening its scope to sanctioning intermediate entities, and Russia's dollar reserves are collateral for loans to Ukraine. And so, if we set aside the morality of that situation, this going nuclear with the weaponization of the dollar was such a public and arbitrary use of economic power for a political purpose, that it forced the rest of the world to realize, the same thing could happen to them at the same time, at any time. And, for little over 80 years, dollars have been known to be assets. And now they're potentially liabilities that could disappear when you need them most. So it's no wonder why dozens of nations are actively de-dollarizing. And it's not just geopolitical rivals like Russia and China. Saudi Arabia, Brazil, India, the United Arab Emirates, even the European Union are actively de-dollarizing. And so developed economies, as well as emerging nations, it's a rapidly growing trend. And I would say, projecting out to the next 5 years, the global debt crisis isn't going to get better by itself. We've got, when we talk about global debt, we talk about country institutional debt, we've got central bank debt, but also let's not forget, on a very, very personal level, we talked about it before when we talked about, causes of property crashes. But underlying those causes, I would say it's a cost of living crisis, right? If rates are 4%, well, then that's kind of a 300% increase from where they were at its cheapest, 3 or 4 years ago. I, for one, I'm worried when I have to renew my mortgage, things will have to, there will have to be some compromise, because I'm going to have to pay 300% more for for no difference in what I have in probably a year's time. Everyone's on slightly different time frames. Some people will be able to afford that, and some people won't. And the people that won't or can't afford that will have to start selling. And in order to avoid fire sales, people have to start selling earlier to avoid a situation in which they really are desperate. You asked me before, what sort of trends are we seeing in property? Well, that's exactly it. You know, we're starting to, I'm not saying we're starting to see, we've seen now over the course of the last year and a half, people starting to sell property. Some people have come unstuck, haven't been able to sell their property just because, you know, a lot of the buyers out there have been, well, you know, don't want to catch a falling knife. How low can it go? And I think, you know, there's a little bit of what's the word? Um, Sellers believing that their property is worth more than it is, right? And so when you've got such a gap between sellers that believe their property is worth more than it is, and buyers that are saying, well, not to me, it's not, because actually I'm going to be paying X amount more on my mortgage. And so, you know, no one else is putting offers in. You know, my offer stands at, you know, 20% below asking. When you've got such a wide gap, you know, something has to give. And it has to be the sellers that start to decrease their price. When they start to decrease their price to increase supply, you know, that's when we start to see the value of securitized assets like property, which are essentially owned by the bank, starting to become worth less. And, you know, going back to what we were talking about, projecting out the next 5 years, I think that's a very real concern. You know, people's mortgages are probably one of the largest exposures they have in terms of monthly outgoings. And so I do see that being a situation that will contribute quite considerably to the cost of living crisis. Forget inflation in the way in which it's described to us by the government. If you're paying 300% more for living in the property that you've lived in for however long, when you used to pay a third of that, in my eyes, you are inflating your outgoings. That is the perfect example of inflation. And so, you know, that will mean either the selling of asset classes, or it'll mean, you know, a lot less spending, which then launches the economy back into a recession. We've also got the BRICS alliance, you know, actively working on a parallel global financial network with its own currency and its own digital token, pegged to a basket of BRICS currencies and gold. And I think the safe bet is on continued geopolitical tension, you know, wherever it is. I don't think there's been a year over the last 15 years where there hasn't been something. Stagnating global growth as a result of the increasing debt crisis, and the kind of economic certainty that I think gold and therefore silver thrive in.
Well, that's yeah, fascinating to hear those points, Josh, in terms of your client base and that wider analysis of the market. Sam, do you want to comment on anything there? Because I've just been pulling through some of the questions in the chat. It'd be probably interesting to bring some of those through in a moment. Did you catch that, Sam?
Sorry. I was just in the chat answering a question, so I was distracted on the question there.
I was asking if you had anything to riff off for Josh, but if you're in there answering questions, then
I
maybe
was focusing on the question there. So yeah, my brain was on another tangent. So
Josh,
I can't comment with any confidence.
Okay, do you want to segue now, Josh, onto some of the questions? Was there any other points you wanted to make before we move into some Q&A?
I mean, I think we've covered quite a lot. I'd be more than happy to start answering some questions if anyone thinks it would really help them. So more than happy to cover anything that anyone wishes to ask if we've got enough time to answer them.
Sure. So there's been a couple of questions in the chat here. Sam, did you pick up any in particular that you wanted to bring up? So one of the questions that came up early on was around moving money in and out of gold. And this actually came up to me. I had a similar question. There's a different nuance to this. So what we're seeing, as Sam alluded to in the crypto space, is we're starting to see, my camera's disappeared. We're starting to see banks making it harder, particularly for larger sums of money, to be transferred from mainstream banks into crypto, what we call on-ramping funds into crypto. It's certainly not impossible, and different banks have different policies, and we've got a list of banks that kind of are more favorable. I'm just out of curiosity interested to see if you've had similar issues of people struggling to have money in larger sums, whether they're getting additional fraud checks or phone calls or block payments, just more generally to see if that's a trend that's beyond crypto. And then the second part of the question really relates to moving money directly between crypto and gold. Whether that's something that you accept as a mode of transaction. But if you comment firstly on the difficulties of moving money into a different asset class, have you seen any changes there from some of the bigger banks?
So it's been a growing concern for us for a while now. We know that the banks, some of the time the banks are doing what they do with the duty of care that they have towards the people that they're trying to protect. Sometimes that duty of care kind of goes beyond where it ought to, and it starts to kind of operate in the realms of self-interest. And let's face it, if the banks were to release all the funds that people wanted to release or transfer out, the banks would be in a far more unstable place than they are at the moment. And so I think there's probably a good reason, whether or not the banks call it a byproduct or a consequence of their duty to safeguard clients. But yes, we see huge problems. We actually had a client a couple of weeks ago, very frustrating. She wanted to put in 130,000 pounds into physical gold. Doesn't do internet banking. Went into the bank, took her ID in. She said that this is what she wants to do. She was given the third degree. She was told to she was told to go into another room and have a seat, and she felt like she was being treated nicely because of maybe her age and the fact that she was moving a sizable amount of money. And within 15 minutes, the police turned up.
Oh my gosh!
And the police were taken to the room, and the police then basically gave the client the Spanish Inquisition in terms of why now, why this company, who's making you do this, why would you ever want to take your money out of the bank and put it into physical gold? These things tend to be scams, and so I wouldn't be surprised if it is. And so they refused her from being able to release her funds. She called us back the next day, and it was by no means of a surprise. We hear these things all the time. Obviously, to the client that it's just happened to, they take it very much personally, and I don't blame them. I would too. We work hard for this money, and to be told that we can't do what we want to do with it is bizarre. Completely unjust. And so she decided to go back into the bank to try again. And exactly the same thing happened. Police were called. They said, look, we're not going to transfer this money for you. It's just not something we're going to do. Sorry. And look, there are some people that will fight harder, right? There are people that have more energy in them to fight, to articulate their argument, and they'll win, right? Whoever shouts loudest, they will get there. It might take them longer. I know clients that have had their account frozen for 4 weeks because they've decided to try and transfer a sizable amount of money out of the bank. But they'll still do it because it's reinforcing their decision to get their money out of the banking system. But I think the sad reality of the situation is that there's a certain demographic that they target, and it's almost ironic because they have a checklist of vulnerability, and that vulnerability is a checklist of are they of a certain age, are they of a certain intellect, have they transferred these sorts of sums before? And if they meet that criteria, they are kind of in their mind vulnerable, which means that they will prevent them from doing it. But the ironic thing is that they shouldn't be allowed to stop people from taking their own money out of their own bank account. But that tends to work the best with the most vulnerable.
Interesting.
And so their approach of slowing down the transfer of funds out of banks works best with vulnerable clients, which is sad. I've heard of bizarre stories whereby people have tried to complete on a property or exchange on a property, and the banks have refused to transfer the money to a small firm of solicitors up north, just because it just didn't sound right to them. What didn't sound right? I don't know. It just didn't sound right. You know, so people have basically lost their dream house because the cashier didn't believe that the law firm they were dealing with was bona fide based on the little they knew of the legal system. And they're able to use the guise of protection for customers. So this is an area that I think, we talk about regulation, we talk about regulating cryptocurrency, we talk about, various industries that are there to protect consumers, the FCA, the advertising standards, the ombudsman. But we need something that can actually protect us from the banks that basically turn around and say, look, we're not giving you any of your money. I tried to take some money, some cash out of I misplaced my card, so I had to go in and ask them for cash that I would have ordinarily taken out on my bank card. And it wasn't kind of, eye-watering amounts of money. We're talking a few £100s. And they asked me why I wanted the money and who I was paying it for. It was ridiculous. I mean, I almost kind of expect it if I'm taking out wads and wads of money, which I don't tend to do. But talking about a couple of £100 there.
Crazy. Yeah, I think it's increasing safetyism just gone wild. Out of interest, do you have an unofficial kind of white list of banks that actually tend to be more favorable? We're kind of garnering that in the crypto space now, but there's no hard and fast rule because any one of them can cause trouble. But have you, or on the other side, is there any like most troublesome?
There are some troublesome banks, and what I'll do is I will give them to you. I'll give you a list of them, and you can circulate them around your audience. The last thing I want to do is be guilty of what they do to our businesses, where they say, do not put your money into physical gold with the Pure Gold Company because they've got the name gold in their name, and gold is a non-standard asset class.
Gold is an age-old asset that's lasted before cash. Yeah.
Yes. There are, so I mean, we bank with Barclays, and Barclays have been very good. I mean, we've been banking with Barclays since 2012, and they've been great. And so we very rarely get a problem with Barclays because Barclays understand the asset class. There have been issues with Santander and NatWest, but sometimes it's kind of unpredictable because it doesn't always happen at the level at which you expect it to. It happens at branch level, right? It'll happen at kind of the interpretation of vulnerability. And so one person will go to their local branch in Farnborough and have a huge issue, whereas someone else will go to their city-based branch in London and be absolutely fine.
I'm glad you said that. That clarifies my experience and speaking to lots of people that rather than say it's this bank or that bank, it's totally personal to their branch. And sometimes, obviously, just in terms of it being triggering, it can be algorithmically depending on their account activity. So it's never as simple as saying that. And there are obviously ones that are more friendly, and there are ones who have less limits actually set, or then have larger limits. But in terms of a case-to-case basis, I've seen such varying things for two people in exactly the same institution.
Yeah, I think you're right. A lot of it is based on what you've done before, and algorithms, it's a question of computer says no, and then humans try and justify it. What we tend to say to clients when doing larger transfers is transfer a small amount first. Even if it's £100 or £103, don't make them round numbers. And then transfer a little bit more. And then at that point, you're kind of you're seen as a registered payee, which then increases the chance of a successful transaction below a certain amount. We find that does help. It's not bulletproof, but we find that it does help.
Okay. And then what about moving in this kind of increasingly crypto world? Are you accepting crypto transactions for purchases of gold and silver at this point, or is that? I think we may have asked you that last time around, and
We don't, and we are asked that question a lot. We're asked that question, and um, we're also asked if we take cash. And the reason we don't take cash and the reason we don't take crypto is because if we were to, we would be regarded as a money dealer. And as a money dealer, our responsibilities to HMRC become increasingly onerous, which means that we have to account to HMRC for the identity of all of our clients' transactions, which then makes the asset class they're purchasing the opposite of private.
yeah.
And so we probably lose a slice of the market, through not being flexible to those that want to do that. But I would say that, our goal is to stay true to those that want, a physical private asset class that sits outside the banking system that is capable of being liquidated quickly in a tax efficient manner. We try and tick all those boxes.
Yeah, and Sam, and on just the kind of the development of kind of crypto debit cards, etc. There are more increasing ways that people can easily transfer money. Making payments with crypto debit cards, for example, where the transaction the card, acquirer essentially does the transaction. So it's not a direct sending of an asset to land on, Pure Gold's balance sheet.
No,
It will convert it.
Essentially, Dan, that you're almost using fintech solutions. These
Yes.
intermediaries that are not legacy banks, but they're also in the crypto space, and they're becoming intermediaries. So they are obviously custodial platforms. But I've always said if you could move from self-custody to one of these platforms, sell your Bitcoin into pounds, or some of them leave the Bitcoin on the card. But essentially, it's the same thing because and then you've got a debit, a Mastercard. So if you're dealing with anybody who's taking a Mastercard, that be accepted because you're not doing a deal saying, will you take Bitcoin as Mastercard? And essentially, at point of sale on the platform that hosts that card, they are doing a transaction into pounds from Bitcoin, and then you're paying in pounds. Yeah. That's why sometimes if you're doing one move, that's fine, do it in Bitcoin. But often, if you have the option, it's worth just doing one trade out of Bitcoin into your pounds, and then you've got a Mastercard, and you could then be buying. So it's essentially you're using them as a bank, and it's an intermediary. It's rather than going back via the bank, you are still using a custodial, essentially a banking platform with KYC with action. But some people prefer that because they find, in my experience, is some of these fintech solutions are much more dynamic than the legacy banks. They're much more used to fast paced and they're used to these kind of transactions. So often that's the case. It's not to say you're vouching for them as they are about freedom, decentralization. They are providing that service between the kind of fiat world and the crypto world and be able to off ramp in an easier way than perhaps transferring back to your bank and then moving. So you can have your money on a Mastercard very quickly. So I would say you could be from your cold storage crypto wallet, and be able to be purchasing something online or with a debit card within 5 minutes. Literally.
Yeah, for someone who doesn't understand that intermediary technology, in their mind, they would just be paying with it in Bitcoin, but it's not. You're not paying in Bitcoin.
Exactly.
The transaction is the transaction is still occurring. The conversion into pounds
exactly because the platforms that host the cards are exchanges that therefore you're just executing a sale when you do the card purchase. Yeah.
Yeah, we'll give you a list of those cards, Josh, for next time anyone else you take crypto.
See, that's the point. The no good on the other end needs to know. It's totally normal banking. It's
yes.
No one's to be approached say, can I pay with crypto? It's a Mastercard.
It's still a Moscow. Yeah, it's the liquid. It's still at point of sale. It's converted at that point, as opposed to manually selling it yourself at whatever price you want to sell it for.
You are back into that legacy bank system.
Josh, someone's asked, what are your views on digital metals? We've featured, I think, again, this was a question that came up last time. We've done some stuff with Kinesis here on the show as part of the program. Do you have a view on or digital platforms that are still grounded in physical gold, but offer the ability to purchase effectively smaller amounts?
There's a variety of ways to gain exposure to the same asset class, but in very, very different ways with different levels of protection. And so one has to start by asking themselves, what's the objective here? Is it long-term wealth preservation? Is it moving your wealth outside of the banking system? Is it privacy? Is it tax advantage? If you're trying to tick any of those boxes, if not all of them, then digital gold isn't going to help you in that regard. The reason for that is because that digital currency, be it an ETF or a gold mining stock, essentially it's a piece of paper that is backed by a certain amount of physical metal. It's widely understood and accepted that it's not possible for every certificate that's given out. It's not possible for physical metal to back each and every one of those certificates, and it's accepted that that's okay. But when it gets to the point where there's a lot less metal than there are people selling out of their positions, that's when you can find yourself in a position where the fund can drop to zero. The other thing as well to take into account is when you're talking about digital, there are other costs there. And so there's a disalignment to the spot price because the costs of operating a digital platform are then contributed back into the price that you see, also known as the spot price. And so you see varying degrees of the spot price. You've got the cost of the platform, you've got the operating costs of the segregation and the way in which it's stored. The other thing as well is the way in which it's stored. And so the way in which we do things is we store in a way that removes all and every counterparty risk. So the first thing is we deliver gold to clients, right? That's always the first choice. And then clients can choose to store it wherever they want to do it, wherever they want to store it. Second option is for us to store it in a London Bullion Market approved vault in a segregated and allocated way that's fully insured by Lloyd's of London. And what that means is you get your own vault with your own number, with your metal inside it, insured by the Lloyd's of London. And there's no limit to that. Deposit compensation is 85,000. If you've got 10 million in gold, you're insured for 10 million in gold, right? If you're purchasing digital gold, whilst they may say it might be allocated, it will almost certainly not be segregated. And the issue with non-segregation comes from, third parties. If you're investing into a digital fund, then you have to take a vested interest in that third party and the integrity of that third party. Not just the integrity, right? If that third party were to ever collapse or something were to happen to its platform, cybersecurity or what have you, there'll be a big question mark over access to that metal. What's yours and what's yours. And if, let's say, being able to own £5,000 worth of gold is a question of sharing a £400,000 gold bar with, let's say, 80 other people, well then, who's to say that everyone's going to want to sell, and who's to say that everyone's going to want to, stay in the market? And so you then create kind of a divisive market whereby you've got these huge bars that you can't really sell on the retail market, and so you're going to have to sell them for a lot less than market value in order to raise liquidity. Obviously, I'm painting here a polarized view of it. What I would say is, traders who want to gain exposure to physical gold over the short term may very well find that purchasing digital gold to be an effective, efficient, and cost-effective way of doing things. What I am saying, however, is if safety, security, and wealth preservation are at the top of your list, then you're not going to get that from doing it digitally. The other thing you're not going to get is the added benefit of the tax advantage. And so if we just accept, for example, for a second, that digital gold and physical gold in the form of gold coins are exactly the same, in terms of safety and security and risk and what have you. And we're accepting that they both increase at the same rate. Well, if you're not having to pay tax on your legal tender coins, but you are having to pay tax on digital gold, well, you're 24% better off with your physical gold.
On the point, yeah, thanks, Josh. On the point of estate planning, then, as well, on that point, because one of the questions relates to do they have to declare that the gold is part of an estate? Is that still a requirement?
It may well be. I mean, I can't give any advice in terms of estate planning or probate law. What I can say is that, look, it depends on the way in which people view the world, right? Some people have a watch that they might decide not to put into their estate, or a very expensive gold pen that they don't put into their estate. They can do that because it's a physical chattel. They can do that because there's no real central registration of asset class. And so whilst the right thing to do is to put everything into your estate, sometimes that doesn't happen. Sometimes people might think, well, if I've only got one or two gold coins, then I might actually just give that to my kids 7 years before I die, or 2 years before I die, 1 year before I die. In the same way as I would do that with a watch or something that I hold dearly to me. A lot of our clients see physical gold as an effective transfer of wealth. And in that, there is a sentimental value on that asset class, being able to transfer that wealth. And so, do you have to register that within the estate? I don't know. Probably is the answer. Does everyone register that within the estate? Again, I'm not sure. Probably not. I think when you've got flexibility to do things the way in which you should do things, but in a way that benefits you from a probate point of view, then I think you're kind of getting the best out of both worlds. You can leave it in an estate, but you can kind of convert some of that gold into cash, and some of that cash can pay for probate proceedings.
Yeah. Just on the while we're talking about kind of estate planning, could you just comment, because I think there's still a lack of awareness that gold is an asset that can be included within a pension. Could you just clarify that for people?
Yes. So we've seen a massive increase, almost a 700% increase in the last 12 months of people purchasing physical gold, bullion bars within their pension. In the same way as people remove risk or remove exposure to equities or bonds or cash or commercial property, or better still, people just take diversification with physical gold against some of those asset classes. Again, it's a very good way of being able to remove wealth within the banking system, within your pension. And so, pensions in their very nature are kind of long-term vehicles for retirement. And so, because gold in its very nature is a long-term investment, the asset class and the vehicle are in a way symbiotic, of an inevitability that people want to be in when they come to retirement.
Yeah, very, very, very important. There's just then lastly, before we wrap up, there's a few questions around vault and access. Could you comment on the kind of, you've touched on it already, I think, but the storage options that normally come. So number one was that you can self-storage it and self-custody. Number two was that there is a third party vault that is insured by the Lloyd's of London as an insured asset. Is there any risk of being unable to access your gold from a bank vault?
From a bank vault?
Yeah. Could they refuse to release it in the same way that you've seen problems getting money in and out?
Bank, you know, safety deposit boxes in banks are, almost a day of the past. It used to be kind of possible to do that, and I believe, I think you can do that at Metro Bank. I'm not sure if they're still doing it, but a lot of the banks have removed safety deposit boxes, and so by and large, it's very, very difficult to do that. And even if it were, my suggestion is to use a safety deposit box center, whereby you have your own access, you have your own key, you have your own access card, you can access it whenever you want to. And so for me, the varying degrees of storage come down to taking delivery and storing it at home, somewhere safe, storing it in a safety deposit box, somewhere that you trust, somewhere that you can gain access to, making sure that you insure it within that safety deposit box. And sometimes, the insurance that you can take out might not satisfy, every eventuality. And so we've got clients that have invested 7 figures and they only feel comfortable storing their gold in one of our London bullion market approved vaults. Now, they're not our vaults. We store with either Loomis, Malka Amit, or Brinks. And two of those are public companies. Corporate governance is second to none. They audit both internally and externally, and effectively, you get you have an audit of your own vault with confirmation from the vault of your holdings. We've got clients that every now and again just seek a release of those asset classes directly to their home address just to see it and then send it straight back again, just to test that process out.
Fascinating.
It's fully insured, and in terms of storage charges, they're negligible because we pass over those institutional storage rates.
Of course. Yeah, thank you. Okay, we'll take one final question then. So Sophie says, if someone wants to relate it to crypto, if you want to move money out of crypto into gold as a short-term hold and then sell that gold to buy back into crypto in, say, 6 months, which is an interesting use case, actually, with the volatility in the markets, we predict these kind of cycles. So if you wanted to move money into gold and then take it out of gold again, what sort of percentage would you lose on the gold at the point of sale? Is there a liquid way of using gold to kind of bridge market cycles?
So physical gold traditionally isn't really used as a short stopgap, just because, like all other asset classes, there is, a difference between the buy price and the sell price, and that will change based on, first of all, what you're buying, second of all, how much of it you are buying. And so if we keep this really simple and straightforward, the difference between the buying price and the selling price, take into account the gold price stays the same. Let's say for 1 ounce Britannias, for example, you're looking at around 4.5% to 5%, right? And so you would need the market to move by that amount in order for you to break even. And so if you decide to kind of crystallize your gains in crypto, park it in gold for 6 months, and the market hasn't moved at all, well, then you're going to be offside. I say that as a caveat. The annual average increase in gold over the last 50 years has been just under 9%. But in order to have any statistical significance, you need longer than 6 months. And so that's not to say that we haven't had clients that have sold property that are looking for new properties, don't want to keep it in the bank, don't fancy their chances in equity market, don't want to tie it up in a bond, don't want to put it into crypto, and they will park it in physical gold. And they accept that, if the market doesn't move at all, then they're going to be offside by X amount. But for them, the price that they are paying is that amount, but what they're getting is safety and security. With any asset class, I mean, gold is a stable, secure asset class. But like anything else, the shorter the period in which you're holding it, the higher the volatility. I'm not suggesting that you're going to see huge swings, but if the market stays the same, then you're going to be offside slightly.
Yeah. Okay, just to conclude, we did have one emailed in to us actually about the VAT with the silver. Is there a way to navigate or minimize the VAT implications of investing in silver?
Yes. So I would say 99% of our clients that invest in physical silver through us, they purchase silver half Britannias or 1 ounce Britannias because there's no CGT on the game, and they store it in a bonded vault under our supervision. And because it sits within a bonded vault outside of free circulation, it doesn't trigger the need for us to charge VAT.
Is that a UK-based vault?
We've got vaults in the UK and we've got vaults in Switzerland.
Okay. And can people choose where they're stored, or is that down to
they can choose, yes.
Okay, fascinating.
We've got vaults all over America and Switzerland and the UK.
Fantastic. Okay, cool. Thank you very much. Well, Josh, this has been a wonderful session again. It's, getting a really comprehensive overview of the state of play as we are 12 months on. The most important thing for us to share really is, having had this discussion tonight, if people are curious about taking their conversation further with investing in gold or silver in the ways that we described tonight. Obviously, if you could outline briefly the process that people go through when they engage with Pure Gold. We'll put the links in the chat. We've got the free investor guide as well that we'll put in the chat for people which you can download, and people can book a consultation with your company. So if you could just outline the steps that someone would take if they're just starting out this journey with you.
Absolutely. So as you said, you can download an investor guide to just find out a little bit more information, fill in the gaps that I might have missed. But you can also book in a consultation with one of our consultants who can answer all your questions, that can explain how it works, why it works, and if you want to do it, when to do it. It's a non-pressured kind of conversation that will last as long as you want it to or need it to. So our guys aren't paid commission. They are salaried employees that provide a consultative approach to everyone that they need to speak to. Yeah, as I said, download the investor guide, book in a consultation. Because we're one of the very rare breeds of company that provide a personalized consultative approach, we can't provide all things to everyone. Otherwise, that premium-centric service that we are well known for would slip. And so, I think, I don't know if this was the case last year, Dan, but over the last 15 or 16 months, we have imposed a minimum of £5,000 in order for us to, provide, first of all, the premium-centric service to everyone that we speak to, but also to provide the gold at a competitive rate, which is what we're also known for as well.
Yes, that's right. So it's 5,000 invested minimum. That makes sense. And yeah, we've, as we said at the beginning, if you've just joined us throughout this session, is that a number of our clients that have met you, Josh, who our previous sessions have gone on to invest in Pure Gold, and we're very happy to work alongside you as one of our partners within this program. So you can find the details in the chat there at weareelevate.org/gold, and that will take you to the page where you can download your free investor guide, and at the bottom of the page you can also book your free consultation as well. So we'll put those links into the post session notes, so you've got those. Josh, it's been great to reconnect and to see you again. Sam, any parting words to you before we wrap up today's session?
No, just again, it underlines that we've always said that education is key. And that's why continuing these dialogues, having all the questions, and speaking more about any asset class, you really get informed about the pros and cons of each one is so important. That's what we're all about, and that's why it's great to have Josh on and great to be able to pick their brains. And we should know what we're doing before we actually go and dive into these places, because that's where we can do well and be empowered rather than going in blindly or just on somebody else's recommendation. Let's get educated first. That's where it pays off. So much about investing is actually the work you do beforehand rather than just what happens in the markets. It's how much you put in. So there is a real tangible level of what you put in is what you get out in all these areas, and I think that's what we're doing. That's what we're attempting to do here. So thanks for being here, and thanks for coming along in, Josh.
Thanks for having me.
Yeah, thank you, Josh. Thank you, Sam. So again, that's weareelevate.org/gold for further information. Again, we'll send that out afterwards. A really, really important session again tonight. And thank you everyone who's joined us live. And we'll see you again very soon. Good night for now.